Hello there and welcome back. Today on the Four Pillars podcast, we are talking about the third pillar, and that is the pillar of accounting. Today's topic is the cash flow statement. A basic cash flow statement has four components. It discusses the operating activities, the investing cash flows, the financing cash flows, and finally an overall net cash increase or decrease. With operating cash flows, it can start off with the net income from the income statement. Then we add back the depreciation, because depreciation is a non-cash deduction. And then we either add or reduce the change in the net working capital. These include changes to our accounts receivable, inventory, or accounts payable. For investing, it's the purchase or sale of property, plant, and equipment, other capital assets such as any term deposits or shares that you may purchase in other companies. The next portion is the financing cash flows, and that is two concepts: the debt and equity. When you raise a loan, this is a cash flow increase. When you pay back your loan, it is a cash flow decrease. Similar with equity, if you issue shares, then it's an increase, and when you repurchase the shares, it is a decrease. Similarly, dividends and interest on those respective loans and shares result in further financing cash outflows. So we sum all of these up, the operating, investing, and financing, and then we get our overall change for the period. Then we get our opening cash flow from the start of the period, which the change plus the open should reconcile to equal our closing cash balance. The key thing with cash flows is that cash is king. Cash is security. You can do a lot with cash. You can either invest further into purchasing property, plant, and equipment, or investing in an opportunity, or even surviving if for some reason your operating cash flows start reducing. There are many uncertainties and risks in business, so having a positive cash flow and an ample closing cash balance is extraordinarily key. We're going to talk about a real-life scenario in which there was this Australian company by the name of OneTel, whose logo looked like that. Actually, it looked like that. OneTel is a publicly listed Australian company that operated between 1995 and 2001. This is the cash flow statement from OneTel a year before it wound up. Similar to the template I described, there is operating, investing, financing, and the net cash changes. Comparing the year of 1999 to 2000, the receipts from customers had increased, but so had its payments. Overall, it had a larger net cash decrease. Going on to its investing activities, it had purchased quite a few more licenses, and this also resulted in a much larger decrease. This was all supported by the issuance of shares and borrowings, the result of which at the end was a net cash increase with a healthier and more abundant net cash balance. Hindsight is 2020, but looking at this cash flow statement, because the cash flows are not coming from operations, and in this example here, they've never been positive. With this scope here, the cash flows have never been positive. The result of this is that it was never intended to make money. shareholders will continue to invest, but eventually the resources of the shareholder will invest will deplete away its cash balances because of these negative operating cash flows. When looking at any business, it's really important to look at the cash flow statement. It can really tell a great picture on its viability and if you are ever going to get your money back from your investment.